Right, welcome to another run through of the top 5 charts of the week. So this is the weekly email that goes out for free from the website, and it's just a selection of interesting charts, as you can see there. And the purpose of this video is to just add a little bit of extra context and comment around them, and hope you enjoy it. So starting off with number 1, bond yield seasonality. So you probably heard that term, that sort of market aphorism or axiom or rule of thumb: sell in May and go away. And the rest of the phrases that you should come back in October because that's when the positive seasonality kicks back in. And that really just speaks to the seasonal patterns that you tend to see in the stock market, which is tends to be quite positive in the early part of the year and negative in the later part of the year. I'll probably actually put a poster on that either tomorrow or on Saturday. Very topical as we're about to enter into May. Where did the year go? But anyway, speaking of the year and seasonality, we've got here on this chart 2018 trading for the US 10-year bond yield, very close to hitting 3% as we speak. And as it does make that lurch towards 3%, we've actually got this seasonal boost here, which is quite interesting, really. Actually, I might just try and pull that up, see where it's at. But the over the longer term, so this is from the period 1962 to 2017. If you want to read more about that, you can click on the link there, and it also has a look at how the seasonal pattern works in an uptrending market or a downtrending market. And really the bottom line on that is that the positive seasonality for bond yields, its tendency for bond yields to rise in the first part of the year, is roughly the same for a downtrending market, although the down part sort of starts a little bit earlier. But for an uptrending market, the upward bias, so the tendency for bond yields to rise during the first part of the year is extended all the way till sort of around August, September. But anyway, in the immediate term, it does seem like bond yields are getting this sort of seasonal boost, which is quite interesting, really. And yes, as we go here, it's just a touch off 299. And yeah, so it's pretty much broken out of that key level there. And then actually, if we're jumping all around, let's have a look at the composite flash manufacturing PMI here. So it did tick back up in April, which is pretty key, really, because that fall down there, which mostly driven by Europe, that always casts a little bit of doubt around it. And there seems to be this embedded doubt throughout this, where it's taken a while for the 10-year bond yield to actually catch up to that. But as I noted in this article here, the flash global PMI points to higher bond yields. So we've got this solid global growth inflation outlook. We've got the global central banks starting to pull back on policy, on quantitative easing, and also, just a reassessment of where the neutral Fed funds rate is, because, a couple of years ago when the big popular theme was, structural deflation, and, everyone was wheeling out all sorts of platitudes and thought pieces on deflation, and, the neutral rate, and to be fair, at that time the neutral rate probably was a lot lower, but as the growth inflation outlook picks up, if we see a little bit more, policy measures that are fiscal policy that are more, growth oriented, more budget, point to a high budget deficit, then those are going to be the kind of things that are also going to put an upwards bias to where the neutral Fed funds rate would be. And for longer term bond yields, the average rate of the neutral Fed funds rate over the longer term has a big impact on where the yield should, quote unquote, should be. Anyway, moving back to this, so yep, we'll get that seasonal impulse through May, and then the pattern is for it to top out. But as I said, if we have actually transitioned to an environment where bond yields are biased to trend upwards, and I actually think that we did see the bottom about a year or two ago now, and then we could actually see that positive seasonality continue through to September. So it's one to keep an eye on. Now, thinking about bond market, and just to be clear, and I hope it should be clear for most people, but just to be clear, rising bond yields means falling bond prices. And so when you see this is here's a picture of speculative futures positioning, heavy shorts in US 10-year treasuries, it means that traders are actually well positioned for this another round of sell-off in bonds. So bond yields up, bond prices down, and shorts benefit. So yeah, you can see that they're actually well positioned for that. And if you look on the equity side in the red line, equity the punters on the equity side are positioned for higher stock prices. So what the positioning here is, it's for higher stock prices and higher bond yields. Now, if the bond sell-off goes too far, that'll probably end up spilling over to the stock market again, like it did in late Jan, early February. And if that happens, then it's the equity punters here who are going to stand to bear the most pain. So it's sort of an interesting dynamic there. And now for something completely different, the SCANNZ economies. Standing for Sweden, Canada, Australia, Norway and New Zealand. I received some correspondence from a bloke in Iceland, and he mentioned that there's actually a lot of similarities to Iceland as well, so maybe we should put Iceland into the mix. We'll just have to see if they've got if OECD's collecting those statistics for Iceland as well. But anyway, the common characteristics that these five share is that they're small open economies with their own currency and independent central bank, and fairly decent reliant on or sensitivity to exports and particular commodities. And most important of all, the key commonality they have is overvalued property markets, and hence heightened sensitivity to interest rates. So that's another impact of rising bond yields. So when bond yields rise, it squeezes the equity risk premium, it raises the risk-free rate, and therefore, at the margin, it acts as a headwind to equities. And certainly, if nothing else, it at least gives the opportunity to earn a higher yield. I mean, capital growth or otherwise aside, it presents a higher yield for risk-free assets. So, and that's one way that higher bond yields can have a sort of constraining impact. Of course, higher bond yields can also mean higher interest cost and impact on earnings. But the key way is for borrowing costs for households, because a lot of the times, particularly these countries, their banks do a lot of offshore funding. I mean, that's changed a bit since the crisis, and they've moved to try and have less reliance on offshore funding and more reliance on sticky deposits, so from retail versus wholesale. But if global yields rise, then that's going to impact on mortgage rates, and that's one way that mortgage rates get impacted. The other way is by the local central bank, starting to raise policy rates. But you have global bond yields rise, that's going to increase borrowing costs, and heightened borrowing costs are not necessarily going to force a wave of selling by property owners, because unless there's a whole heap of them that are on very floating rates that are sensitive to rising yields. But as a minimum, what it will do is it will decrease the purchasing power of buyers. So if you could borrow X% or X amount at just 5%, and then bond yields rise 200 basis points, the amount that you can afford to borrow is going to be a lot lower. So it can have quite a dampening effect that way. And when you've got significantly overvalued markets, all you need is a catalyst to set that off. So that's a bit of a risk area to be on top of. And speaking of valuation and bringing in again that valuation indicator for property, you can see there that this is for US. So you've got the stock valuation, treasury valuations, and property. In contrast to the SCANNZ economies, US property valuations that were extremely overvalued in this mid 2000s, so 2006, 2005, 2007 period. But then, as we found out very acutely, is that they had a substantial reset in valuations. So they actually went back to pre-bubble or pre-boom valuation levels. So they actually got very cheap. In contrast, the SCANNZ economies never had that kind of reset. In fact, when commodity prices fell, that forced their central banks to actually go into rate cut mode. And again, in 2015, 14, and that drove another surge in valuations there. So it's quite interesting, really. And then you look at where property valuations are sitting at now versus stock versus treasuries. They're all in the expensive mode, and that presents, certain challenge for asset allocators. Everything's expensive. I guess the only solace is that they're not as extremely expensive as they got in, as equities got in the dot-com boom, or as property got at the height of the bubble, or even as bonds got, during the QE bubble there. So it's quite an interesting chart, really, and it's one that I think that definitely want to have front of mind. But it's not all overvalued. There's commodities. Commodities are still presenting as undervalued. I think that is quite nuanced though. So if you look across commodities, I'm actually still quite bearish on gold and also on copper in the short term. A lot of that could change very shortly if other factors change. If you want more information on that, just let me know and I'll send you some reports. But the other thing there is that, yes, it's cheap, but it might actually get a little bit cheaper again, because if you think about the risks for the US dollar, the risks are actually tilted to the upside in the short term. I think that there's every possibility that we could see, a last laugh rally in the US dollar, very much in the same kind of fashion that we saw in the late 90s. And that could actually drive commodities down, certainly act as a headwind. And the other one is China. A lot of the stimulus indicators for China have been pointing downwards, so they've gone from big easing to slight headwind. Again, that's something that could change very quickly. But my base case is for China's economy to slow down a little this year. But there has been a little bit of change in tone from the Politburo around domestic stimulus or domestic demand, so that's something to be mindful of there. My base case is that because of the withdrawal of stimulus that we've seen in China, that we get a slowdown, but the risk to that base case, where I could be wrong, is actually probably more on the upside. There's definitely the risk that it could be worse than a benign slowdown, but they've got a really good track record for really actively managing their economy. They don't muck around like a lot of democratic governments do. There's pluses and minuses to every system, but when they want to boost their economy, they do it. And it can, their policy settings can turn on a dime. So, I'm very focused on the policy indicators that I track. That I've got a few proprietary ones, and that's something that I will be keeping a close eye on, because if you get that slowdown scenario for China, then that's going to be a headwind for commodities. If they do another round of stimulus, then commodities will be on a tear. So will everything. It'll be a second or third round of global reflation. And if you go back to bond yields, well, they'll have another leg up as well, and we could get to that 3.5% level. Anyway, I'll leave it at there, and if you want to get this weekly email for free in your inbox, just either visit topdowncharts.com, or I'll put the link in the description of the video. And if you've got any comments, questions, be sure to post them in the comment section of the YouTube video below, and subscribe to the channel so that you don't miss any future updates. Thanks for watching or listening.